Welcome back, everyone. Recent market volatility is hitting the world of private funding. Volatility and uncertainty are forcing investors to reconsider where their funding is headed, according to a new report by KPMG. Companies are coming under renewed pressure to justify VC investments, venture capital investments there, affecting the list of potential IPOs this year. Joining us now with insights from that survey, we've got Conor Moore, who's the KPMG Private Enterprise Americas leader. And Conor, help us dive further into this data and what you're seeing, particularly where are the industries, the sectors that are continuing to get this funding in spite of the need for companies to continue to prove that the capital is going to be put to good use.
Morning, Brad. Nice to be here. There continues to be a ton of private capital available, be that private equity, venture capital, et cetera. But we are in this period of uncertainty for all the reasons that we've talked about, whereby actually taking a company public, the window is effectively shut for the time being. And that's causing some of the investors to, take a harder look at some of the potential companies in which they're going to invest. And I think we're still going to see a significant level of funding. I think the valuations, though, that these fundings are going to be at is going to be somewhat lower than it would have been 3 or 4 months ago. So as I say to people, we're kind of in a world where flat is the new up.
Yeah, that makes sense, given what we're seeing in the public markets. Conor, walk me through a little bit how there is still such ample funding in the private markets, because presumably private investors have money in the public markets as well, or they have got money in crypto or what have you, and that pile is getting smaller. So I'm just curious why we are still, and we've been asking people about this for a while, why we are still not seeing any kind of contraction in funding in the private markets.
Well, I think, Julie, it's a little bit of an accumulation. 2 years ago, we were all fearful that, all sorts of bad stuff was going to happen in the markets when we hit the pandemic. And, for whatever reason, we had 2 years, like 2021 was obviously a banner year as it relates to IPOs, et cetera. So there was a lot of accumulation over that period of time, very, very successful exits that delivered even more capital to these individuals who are managing it. So, yes, there will be a little bit more caution as to how to spend all this dry powder, but there's still a fair amount of it that exists.
And for the companies that already have gotten funding but are still in early stages, it did feel like that the last couple of years were amazingly profligate, right, in terms of the funding that was happening. Are we going to start to see, or is it too early, are we going to start to see failures of some of these early stage companies that got a lot of money and the idea was perhaps, or the business plan was not fully baked?
I think, Julie, we will. And honestly, I think we probably saw some over the past couple of years. They may have just been kind of outshone by all the success stories and the huge valuations that were in place. I think there will definitely be some that will probably fail. I think, the extra scrutiny that's going to be put on profitability, the impact on certain business models of inflation and the supply chain, et cetera, is going to make some business models a little bit harder to optimize, and therefore we likely will see some failures.
For companies that are on the verge of failure, if they do not receive extra capital, how much might that actually push them towards the public market? I think, Brad, as you say, the worst time to go raise money is when you actually really need it. I don't know that they would necessarily go to the public markets. I think what we might see in those situations is actually companies doing their best to be sold. That is another dynamic that I think we're going to start to see. Companies that potentially thought they were going to go public or were trying to do a SPAC, they may end up now looking more likely to have their exit through a sale. And then the potential buyers, these companies would be, more affordable than they potentially were 4 or 5 months ago. So we could see, a further uptick in M&A activity.
Well, that's interesting. All of these sort of consequences that you don't expect at a time like this. Finally, I want to ask you, of the areas that are still getting investment sector-wise, what are some of the trends that you're watching?
I think for obvious reasons, given what happened in Q1, I think cybersecurity continues to be a very hot space, and I would expect that to continue. We're seeing good funding in areas like ag tech and health tech. And then I also think any company that's looking to address the supply chain problem has probably got some reason for optimism for the rest of the year too.
That makes sense. Hopefully they can come help us all. Conor Moore, KPMG Private Enterprise America's leader. Thanks so much for joining this morning. Appreciate it.